question you should be asking yourself is not, you shouldn't be focusing on the profit. You shouldn't be looking at how much profit can I make. It's how much exposure am I putting out there? What do I stand to lose? What's the worst case scenario?
Am I wrong, or do you see really somebody just breaking the mold, coming out with some incredibly lucrative model that nobody else has seen?
No, I don't. I think, like you said, they're all very similar. I think that the main difference between them is the reputation behind each firm.
Those 5 things: trading plan, risk calculator, solid education, a good support group, and ideally a mentor. And incidentally, all of that is available at Kickstart Trading.
I've actually heard from somebody who I trust, who's a very well sort of a sourced person in the business, that there is so much prop trading right now in the retail space that it almost equals actual real retail trading in the CFD space. It's certainly giving it a run for its money, which is just astounding when you think about. And I'm talking about, what I mean by that is people are spending almost as much money on prop evaluation challenges as they are spending on their own trading accounts. Just really astounding that in 2 years you've been able to achieve that. You're in the markets for the game, for the challenge. And that's probably, I think, why the prop business has taken off so much, because it allows people the opportunity to engage, to have that challenge against the market.
And they throw these big numbers at you, like getting access to $1 million. That's great. And you actually have that. I guess you can think of it, that's the leverage that you can play with, which can allow you to trade bigger positions. But yeah, once you hit that limit, that's really actually all you actually have. But I think there are some good points to that, because if you're someone that can't control yourself, you're better off gambling with someone else's money.
I understand that too much regulation could be argued against as well. It sucks the entire money out of the system, which can suck out of a lot of the innovation of things. So I don't know. I'm not saying I have the holy grail or answer in the regard, but I do think there's probably an argument for, expectations of what is being said as a 100K account. And really you're getting access to 10K in true ability to trade it the way you want to trade it.
Right. Put a lot of emphasis on the time you're staying off the screens, really learning strategy, really learning to put together models and frameworks for how you manage positions and what you do in a variety of situations, because the markets are very dynamic and we have to think through lots of layers of things. But risk management obviously being wildly important. And so when it comes to taking considerations to losses, I would say we want to take our losses very serious, but we don't want to take them too serious, because it is a part of our job. It is a part of the life that we've signed up for. And it's one of the things that makes trading very difficult, is nothing in our life prepares us to be a good loser, unless maybe you had a tough home life. And I'll tell you, I think that when it comes to trading, specifically our losses, it invokes something like the law of averages. And there's a Bible story, actually, that would remind me very similar of when we enter a trade, what happens next. There's a biblical story about a man who goes out and he sows, seed in his field. And as he throws out that seed, some of it falls by the wayside. Some of it falls upon thorns. Some of it falls upon stony ground. And then some of it falls on good ground. The wayside, as soon as it plants, it's just trampled out and nothing happens. The stony ground, it lands, it starts to grow, but there's no roots and it just immediately fizzles out. The thorny ground, good, it grows, it becomes a nice plant, but it gets choked out by the thorns and it never sees a real plant. And then the good soil, happy days, everything's beautiful, they return 30, 60, 100 fold. Our trades are the same exact way, and this isn't something we can't escape. This is something we have to accept. Sometimes you will put on trades that fall by the wayside, and as soon as you enter that thing, it just goes the way, it's just done. It was a bad idea, or potentially you just did something wrong and the whole thing just falls flat. Sometimes you enter these trades that are on stony ground. It will look like it is working out, but there's no substance to it. You're not on the right side. You don't have the right read of what's happening, and that trade is going to fail on you. Some trades are going to fall upon the thorns, and they're going to be good. You had the right idea. Your analysis was correct. You were on the right side, but something just chokes it out. You're going to run into a news event that wasn't slated. It just hit the wire. A big player is going to step in for some reason that you have no idea about, and they're just going to crush that trade. You did everything right, but it still got choked out by something you couldn't control. And then some of your trades, they fall on good ground. You enter them, they go straight to your profit target. and you feel like you cracked the code to the market and you're a genius now. Yeah.
Yes, absolutely. I've gone through quite a few of them, to be honest, over the years. And one thing that I would like to actually say here is you're 100% right. Like, you got to go through the bad to actually come out and basically on the good side. You have to go through the trenches. Anything that you do in life will take actually quite a bit of time to actually master and get good at. If you want to be a good mathematician or, whatever you want to do in life, you got to go through the education. You got to get the education. You got to get the experience. And then basically you got to master the game as well. So I couldn't agree more. Like, absolutely.
Another thing with funded challenges, I think a lot of people take them out of despair, meaning that they save up, a lot of money for them and they spend it on a challenge, and this challenge is everything to them, right? If you go into that challenge like that, you've already lost. If you care about losing that money, most of the time you've already lost before it started. Another thing for traders too is they need to focus on their personal development, like your mindset, your discipline. Like a lot of people, they want to manage millions of dollars, they can't even wake up at the same time every day. There's a lot of that I see in this space. Everybody wants that get rich quick that takes no money, it takes no credit score, takes no skin in any game, and that's that in trading, right? It's that, and people fail to understand that there's no such thing as that get rich overnight thing. It's going to take a lot of investment in yourself and in an education, your time, and that is really the most important factor in passing a challenge, is making sure you're actually ready for it. And the reason that firms have such a high failure rate is not necessarily because nobody knows how to trade. It's because so many people go straight for them when they have no idea what they're doing at all.
We don't just have trading or problems. We have personal problems that show up in your trading. And what's interesting is as you go about growing as a person and as you fix these areas of your life, they fix in your trading and you become a better trader. And it's this really beautiful thing.
An outcome of twofold. One is the prices versus a year ago are coming down because last year prices were really high. So the rate of increase is certainly slowing down. And I think second of all is a result of some decreases in the supply-driven cost factors, in particular for more goods rather than for services. So if you go and look at the labor market, yes, you're right that the labor market in the US is still really tight. Yes, you're still seeing wage inflation increasing by 5.3%. You are seeing unemployment rate marginally raised from 3.4 in April to 3.7 in May. So yeah, the market is still extremely tight, right? I think you've seen some news in the press that's been announced by organizations throughout the US that are looking at reducing their workforce. And that has been made quite evidently clear through the media. I do feel, though, that they are still, despite that, there's still an increasing purchasing power from the consumer. I think there's another concern here which would counter all this, which is the current economic growth, right? You looked at quarter four, we're at 2.3%. In quarter one, we saw that number drop to 1.3%. Actually, that's the revised one forecast. The initial forecast in April, was 1.1, and they revised it upwards in end of May for the quarter one GDP growth of 1.3. So it's halved in terms of their growth. So so basing all that on the tight labor market, I'm assuming that the interest rates will hold at least all the way through to September, and then what we are expecting is that you'll start to see in quarter four marginal reductions in inflation, in the interest rates and in inflation. But then in the back end of the year, we're seeing already prices increasing, and we're not expecting the war on inflation to be over by the end of this year. I think, though, from an inflation perspective, I think the UK market, which we have Trueflation does have an index on as well. And the Trueflation expectation on the UK is that downward trajectory on the UK inflation will continue. I think that is consistent with a number of other markets around Europe. The question is it coming? Is the increase in interest rates going to cause a number of economies to go into recession? We have moved away from a supply-driven inflationary market to now a more demand-driven inflationary market, and the labor market in particular and how that labor market reacts is going to be a critical factor for the long-term evolution of economic growth. I think the US dollar will go from strength to strength again. I'll have a few ups and downs in the back end of the year and going from where we are now, but I think it will remain strong. And if it continues to remain strong, I am more optimistic about the US economy than I am about the European economy and the outlook that they have. But I think the US dollar will hold strength, will be strong for the remaining part of this year.
I don't trade the fundamentals, but when it supports the technicals, for me, it makes a good trade.
It's so interesting. Usually everybody always goes, oh, the technicals need to support the fundamentals. You flip it around, which I think is actually the smarter way to trade, because technicals express price action. Price action is already embedding the fundamentals. And if, you're just basically looking for that fundamental catalyst to push your technicals away. And it's actually a really, really good way of looking at it.
Because I'm a trend trader, I look for pullbacks. And if I have a pullback that is predictive of a buy setup, I have special criteria for buy setups or different strategies that I use. And I use my stop. I place my stops below pivots for long positions and above pivots for short positions.
I've been relying on this type of thing since 2006. It basically just gives me my edge in the markets. I want to be typically buying what's strong and selling what's weak as a trend follower.
Right.
And this basically tells me, it doesn't predict the future, but you can see down here at the moment, this I think we might talk about it later, but that's the Japanese yen. And we know that the Japanese yen, once you had that sort of yield tweak last week when they were buying yields at 1% now, the yen surged higher, but now you can see the yen is the weakest currency at the moment.
I don't know if most of the viewers may not notice, but in UK, mortgage rates are not fixed like they are in the US, and they're literally variable. And like, imagine if anybody who's got a variable mortgage in the US, I have my wife for some reason decided to take some equity loan out for like nothing, and I have to service it. It's a nightmare. It's a nightmare. It's like your interest costs are like double what they were just a year ago, and this is a problem for almost every UK house owner. But this is like the sweet spot of actually equities, kind of like it's the 6 a.m. to about 11 a.m. New York, which is the London morning to New York to London afternoon. That's when you get a huge amount of movement in futures, and there's trades to be made before the U.S. Open even. They're really good.
And one other thing that I've noticed, by the way, and I don't know if Boris, you may have noticed it as well, the bigger moves and the triggers are coming at the beginning of the month. And I have noticed a lot of times that towards the end of the month, they're kind of like sideways and they're waiting for the month to end before they reach a decision.
In terms of volatility, you've heard that expression before, sell in May and go away, the stocks. Yeah. Anyone that's been selling in May and gone away has mostly lost a lot of money. Stock markets are, pretty sort of strong risk-on tone at the moment. I think the biggest currency play for the next quarter is basically the Japanese yen.
I don't take time off in August. I think that August offers a great opportunity for day traders and also for swing traders. Earnings season is still very strong for the next 2 weeks. And then we're going to start slowing down a little bit.
He says, all we are at the end is just dopamine machines. And I thought that was really, really true. Because that's literally what we fight every day is we just, it doesn't, we never want to admit it to ourselves because we think we're so far above it. We're not junkies, but we really are at the core of it. All of us are just dopamine machines. And that's actually realizing that really, really helps you sometimes control that, because you realize that you are just chasing that high. Now, we're kind of just basically, from a trading point of view, I think finding ourselves into a very difficult market. And I think these are the kind of markets that actually bankrupt traders who are not careful. What's your survival tool? Like how do you survive? I think I have an idea what Austin is going to tell me, so I'm just curious, but because you're going to tell me you sit on your hands probably, but
no, I'm not going to pop out that easy, Boris. We're on the trading battle, first episode of the year, Boris.
Exactly. We want to know the juice. We want the meat.
Right. But I will give a good answer, a little bit more elaborate than maybe just an indicator. Maybe I'll let Tom do an indicator because he probably has some good ones there. I'll say risk management is the survival tool. If you understand the market that we're in means aggressive profit taking, cutting losses as fast as possible, building rules and systems into your strategy that allow that to happen through study, through back testing, you can look at your previous trades within the strategy and say, how can we be getting out of these quicker? How can we be making more on these trades? Doing that kind of assessment and then applying what you're getting from that assessment into your risk management, that is the survival tool right now. That's why I'm doing pretty well this year so far, while some guys are getting chopped around, like Tom said.